Assalamualaikum. My name is Muhammad Ibrahim bin Rudi, and today our group will present our QMT 556 group project assignment with the title of Risk and Return Article Analysis. Before we start, let me introduce our group members, and I'll start with myself. Once again, my name is Muhammad Ibrahim bin Rudi, and there is Nabila binti Jeffrey Anau, and the last one is Theodora Tubong Stanley. We chose chapter 8 for this project assignment, and before we go into deep further, I will talk about the content in chapter 8, which is portfolio risk, portfolio return, and capital asset pricing model, or we can call it as CAPM. Okay, the first one is portfolio return. Portfolio return represents the total gain or loss from an investment portfolio over a specific period, expressed as a percentage of the initial investment. Then, portfolio return also help assess the overall performance and effectiveness of an investment strategy. Portfolio return include the performance of various asset classes such as stocks, bonds, and alternative investment. And they are the formula of expected rate of return. The second one is portfolio risk. Portfolio risk refers to the potential for loss or underperformance in an investment portfolio due to factors like market volatility, interest rate changes, and economic downturns. It also includes systematic risk and unsystematic risk, emphasizing the need for risk awareness. And portfolio risk can be measured using metrics such as standard deviation, beta, and a value at risk to help manage exposure to losses. The last one is capital asset pricing model, or we can call as CAPM. Okay, CAPM links the expected return of an asset to its systematic risk measured by beta. CAPM used to calculate the required rate of return on investment, helping investors make informed decisions based on risk and return. CAPM was developed in the 1960s by Shep, Littner, and Mosin, and they also stated that higher risk have a higher return. Okay, there we can see the CAPM formula.
Next is the introduction of two articles. Article 1 is from Rutkowska, Zierko et al. 2024. In this article, it presents innovative research on the capital asset pricing model CAPM by testing new versions that incorporate accounting information and downside risk measure. It also introduced two innovative condition CAPM model that combine market and accounting factors. It also to examining the impact of market condition on asset pricing while taking business financial into account. In the study, it also focused on NYSE list stock and demonstrate the average profitability ratio and accounting beta, a significant source of systematic risk. In the study, it revealed that the condition CAPM approach is more effective than unconditional relationship, particularly during market downturns. This research also contributes significantly to both academic understanding and practical application in asset pricing. Next is the second article, which is from the same author but different year, from Rutkowska, Zierko et al. 2022. In this study, it examined the capital asset pricing model CAPM and its application on the London Stock Exchange (LSE). It investigating both conventional and downside risk approach. While traditional CAPM use variance as a risk measure based on Markowitz work, in this research is explore alternative approach to better reflect investor preference and market realities. In this study, is especially important since it fill a critical research gap. The research finding in this article is demonstrate that the relationship between conventional beta coefficient and realized rate of return varies significantly between rising and declining market. Therefore, the result will show the downward risk premium that are positive and statistically significant with a slight advantage of downside measure over traditional approach in asset pricing.
Let's dive into the methodologies used in these studies. Both articles explore the CAPM and its downside variations, but they approach the analysis differently based on their objectives and the markets they study. Article 1 examines companies listed on the New York Stock Exchange, including firms in the Dow Jones Industrial Average, over the period from 2010 to 2021. This study uses a broader methodological approach by incorporating both traditional market beta and accounting best betas. Traditional beta measures the sensitivity of a stock's return to overall market movements, while accounting best betas, such as return on assets (ROA) and returns on equity (ROE), assess how a firm's financial performance responds to the broader market conditions. To address the limitations of traditional CAPM, Article 1 also includes downside risk measures. Downside beta is calculated using lower partial movements, or LPM, which focuses on losses below a specified target, such as a required rate of return. This is particularly important for capturing investors' concerns about underperformance. The study tests two versions of CAPM: the unconditional CAPM, which assumes stable market conditions, and the conditional CAPM, which separates analysis into bull markets when returns are positive and bear markets when returns are negative. This allows the authors to explore how risk premiums behave in different market conditions. To validate the results, the study uses statistical methods, such as t-tests, to determine whether the risk premiums and betas are significant. Article 2 focuses on the London Stock Exchange and analyzes data from FTSE 100 companies over a longer and more turbulent period, from 2008 to 2020. This period covers key financial events like the 2008 global financial crisis and the COVID-19 pandemic. The authors emphasize both conventional beta and downside beta, but go deeper into the downside CAPM framework. They calculate downside beta using three established methods: the Bauer-Lindenberg model, the Harlow-Rao model, and the Estrada model. These models measure systematic risk by focusing on negative deviations from a reference point, such as the risk-free rate or zero returns, providing a more nuanced understanding of risk during adverse market conditions. The study employs the Farmer-McBeth two-stage regression methodology to test risk-return relationships. In the first stage, they calculate beta values using time series regressions. In the second stage, they use cross-sectional regressions to link realized returns to these beta values. Article 2 also tests conditional CAPM by analyzing risk premiums separately during bull and bear markets. This allows the authors to identify how downside risk is priced in positive and negative market environment. This approach is particularly relevant for understanding market behavior during periods of financial stress. Now let's proceed to the similarities between the articles. Both studies examine the traditional CAPM and its downside variation, the downside CAPM or DCAPM. They focus on understanding how systematic risk impacts returns and how downside risk provides a better explanation during negative market conditions. Both studies use similar risk measures like lower partial movements and semi-variance and emphasize the importance of portfolio-level analysis. They also consider conditional CAPM, which analyzes performance during bull and bear markets. Now let's look at the differences. Article 1 focuses on the New York Stock Exchange and uses data from 2010 to 2021, including metrics like return on assets and return on equity. This makes it more relevant for firm-specific risk analysis. On the other hand, Article 2 focuses on the London Stock Exchange from 2008 to 2020 and places a strong emphasis on financial crises such as the 2008 global crisis and COVID-19. Article 2 dives deeper into downside beta models and how risk is priced during market downturns. So, while Article 1 offers a broader methodology, Article 2 provides more insights into how markets behave during stressful periods. for comments, let's start with the theoretical perspectives provided by the articles. Article 1 adopts a broader approach by integrating accounting-based risk measures like return on assets and return on equity. This perspective is especially useful for investors and analysts as it provides firm-specific insights. ROI is highlighted as a central measure of economic performance, ensuring a balanced view of risk. In contrast, Article 2 narrows its focus to downside beta models, emphasizing risk and return interactions under negative market conditions. While this deep dive is informative, its application is more limited when compared to the broader scope of Article 1. Moving on to targeted markets and time periods, Article 2 focuses on the London Stock Exchange, with a particular emphasis on periods of financial crisis such as 2008 to 2010 and the COVID-19 pandemic. This approach makes the article highly relevant for understanding downside risk pricing during market stress, a critical area for both policymakers and investors. On the other hand, Article 1 examines the New York Stock Exchange, covering a more general time frame. Its primary focus is on balancing market and firm-specific risks by incorporating accounting-based measures. While less crisis-specific, this broader time frame provides a more holistic view of risk management strategies. Finally, let's look at the common insights and differences. Both articles agree on the reliability of portfolios over individual asset comparisons, and they provide valuable contributions toward enhancing the CAPM framework. However, there are notable differences. Article 1 provides firm-specific insights by combining accounting-based performance measures while multiple downside beta models. In contrast, Article 2 dives deeper into risk dynamics during down market situations, offering better insights for stress market conditions. Together, these articles complement each other, offering alternate perspectives on improving risk and return analysis.
Okay, next I'll continue with analysis for both articles, which we can divide it into three parts, which is capital asset pricing model, risk-adjusted return measures, and suggestion for future research. The first thing we can analyze for both articles is capital asset pricing model or CAPM. Okay, for the first article, they use the CAPM to connect the expected returns with symmetric risk, highlighting its theoretical foundation. The second article also used the CAPM, but this time they critiques its limitations, focusing on reliance on historical data and failure to address certain market anomalies. Okay, there we can see how CAPM can adapt to various market conditions, enhancing its practical relevance. The next thing we can analyze for both articles is risk-adjusted return measures. Okay, for the first article, they highlight how the Sharpe ratio and trainer index help investors assess portfolio performance against risk, providing real-world calculation insights. In the second article, they analyze trend in risk-adjusted return research. Okay, there we can see or we can know that the first article offers actionable insight for investment decisions, while the second article provides a broader historical perspective on these measures. Okay, next is suggestion for future research. Okay, the first one is future research should explore integrating downside risk measures into asset pricing models, particularly in emerging markets, to understand the impact on investor behavior and market dynamics. Then, future research could examine how including downside risk in models influence investment strategies and risk management practices among institutional investors. There is a need to develop more dynamic event study methodologies that can adapt to rapidly changing market conditions, incorporating real-time data analysis.
In conclusion, the two articles provide valuable insight into investment in asset pricing and the evaluation of risk and return. The article from Boch, Rutkos-Kaziarko et al. 2024 and 2034 introduced conditional CAPM model. But in the article from Rutkos-Kaziarko et al. 2034 2004, it introduced conditional CAPM model that take market dynamic and company financial health into consideration, emphasizing the integration of accounting data and downside risk metric. Compared to article from 2022, show that downside risk measurement offer a minor advantage over traditional method by comparing conventional downside CAPM approach with a focus on the London Stock Exchange LSE. Based on the board article, research highlight the shortcoming of the conventional CAPM and the importance of adding more complex risk metrics to increase the accuracy of asset pricing. This study significantly enhanced both theoretical and practical understanding of CAPM application in different market conditions.